Okay, so we write minus 2,000 here. If we sell it today, is there a tax effect?
Yes.
Depends on whether there's a gain or a loss, so we've got to figure that out. What's the tax effect? Well, we have to know the current book value. How much is that? So we get the 42,000 we paid originally. We subtract 3 times 5,000, so we indeed get 27,000. We sell it for 25, so what do we have? A loss. We can use that loss to deduct from our current income, and so we've got a tax shield. When do we get that tax shield? Right now, because we're in the current tax year, so we can write it off straight away. How much is it going to be? 800. We're going to take our 2,000 loss, and we're going to multiply by the tax rate to get the tax shield. So it's going to be 0.4 times 27,000 minus 25,000, which is 800. That's the tax shield from the book loss. Any questions on that? So that's the old machine. That's how we deal with that. What about the new machine? Well, it lasts for 5 years, so we've got 0, 3, 4, 5. First obvious cash flows, we've got the cost. That's going to be 30,000. It occurs at what date?
Sorry, just ask the old machine.
Oh, yes.
Why is it that we're instead of recalculating the loss at year 5, because technically we sold it now, right? So it makes sense to use the tax shield and the loss now. But why do we have that negative 2,000 out in year 5 when it was already sold at the time?
Okay, so the question is, why do we have this minus 2,000 out here at year 5? And the answer is that if we held the machine, what would we get 5 years from now? We'd get the 2,000. We no longer get that, so we record it as minus 2,000. Okay. Any other ones on that? So this part of the being the marginal cash flow. Okay, at date 0, we pay this cost. So we've got minus 30,000. What's the tax effect? You buy an asset, how do you take account of the tax issues? You depreciate it. So we're going to calculate the depreciation tax shield. When's the first time we get it? Next year, day 1. We're going to be here, multiplied by TC, or 1 minus TC? TC, it's an accounting charge, so it's 0.4 times. How do we calculate? We take the 30,000, we subtract salvage value, which in this case is 0. So this We then take and divide by the number of years, which is 5. And if you work it out, it's 2,400. So that's how we do. And then, what else would we have normally but we don't have here? Normally we get what at the end? A salvage value. In this case it's 0 though, so we can ignore it.
First off, how did you find this guy?
What do we get though? Why are we doing this whole procedure? We want to shave the operating expenses. And we know that it reduces operating expenses by 10% if we buy the new machine. So we get some savings. What's the first date we're going to get them? 1. And then, how much are they? Well, they're 10% of the 50,000 operating expenses. So it's 0.1 times 50,000. Do I multiply by TC or 1 minus TC? 1 minus TC. It's actually a cash flow, so it has to be, it's a savings, you have to pay taxes on it. So we're going to multiply by 1 minus 0.4, in other words 0.6 times 5,000, which is 3,000. And we get that years 1 through 5. Any questions on any of that? So now we've got our marginal cash flows, and what we need to do is to figure out, do they have a positive NPV or negative NPV? There are 2 ways we can do it. We can either do it horizontally, or we can do it vertically in some columns. In this particular case, it's probably easier to do it horizontally, row by row. So let's do the date 01s. We've got 25,000 for the sale of the machine, and we've got the 800 tax effect from the book loss. Then we buy the new one. Then we lose the depreciation tax shield on the old, we gain it on the new, and we have the savings in operating expenses. So we have minus 2,000 plus 2,400 plus 3,000. We get that each year for 5 years. What is that? Annuity, so we multiply by the annuity factor for 5 years. And then the discount rate is 16%, so we use a 16% discount rate. We have 1 cash flow remaining, which is what? That's the salvage value, the 2,000. We lose that, and then we multiply it by what kind of factor? Discount factor. 5 years, that's 16%. If you work that out, it's 5,980. What should we do? Buy the new machine, sell the old one. Creates value for us. Are there any questions on any of those? Yes.
For the new machine, if there was a salvage value, would it just be a positive salvage value at year 5?
I suppose we had a salvage value of 6,000. It would come in at year 5, and it would be plus 6,000. Again, the standard assumption that we're going to make, unless it's stated otherwise, is that you sell it for the actual book value. So there's no tax effect. Other questions? Yes?
So if instead of horizontal, you do column, then you just go from year 0 and just sum up.
So we could do it, and we'll do an example like that where we go down each column and add them, and then do year by year. This time, because we've got 3 annuities, it's probably quicker to do it this way. Other questions?